Equities have been shaken by global trade uncertainty, but how are other parts of the market, like high-yield bonds, holding up? Joining us now to discuss his outlook is Justin Montini, VP for High-Yield Portfolio Management with TD Asset Management. Great to have you on the program, Justin.
Thanks for having me on, Greg.
All right, so we're talking about high yield today. We don't talk about the high-yield credit space a lot on the program. Maybe a little primer for our viewers who are a little new to the space. What are we talking about?
So high-yield bonds are bonds that are rated less, or they're rated BB plus or lower by the credit rating agencies. This usually signifies that there's something that makes them higher risk. It could be something as simple as being less diversified. It could be something about having a little bit more debt. It could also be that they're very shareholder friendly, and for that reason, they'd be rated lower by the rating agencies, and they would yield a higher interest rate than investment grade bonds. But that doesn't mean that they're bad businesses. A lot of them are actually very good businesses, and some of them include large Canadian businesses like Cineplex, which even though it's in the theater business, which isn't exactly growing, it's essentially almost a monopoly in Canada. And then you also have another company like Air Canada. So these are
our largest air carrier.
Exactly. So these are well-known companies, and some of them are really solid businesses.
Okay, we understand what we're talking about now. Obviously, people and investors watching the show have been living through this recent bout of volatility. What has it meant for high-yield credit?
So up until the end of last year, high yield was doing fairly well. Companies were performing, earnings were strong. EBITDA was up in the fourth quarter by about 10% year over year for high yield issuers. So it was a solid backdrop going into the end of the last year. Since the election, and it continued to do well. Now, if we're talking from the beginning of the year, things kind of have changed a little bit, obviously, with Trump coming in a lot more aggressive on tariffs. That's led to an increase in both interest rate and equity volatility. And credit had remained firm for probably, until about 2 weeks ago. And in the last 2 weeks, we started to see credit spreads, which are essentially the risk premium that is paid above the government bond rate, widen by about 60 basis points, showing that the market is pricing in a higher possibility of recession and potentially inflation. So that's caused a bit of turbulence in the market. And from high yield's perspective, high yield is an asset that performs in most situations other than recessions. In recessions, it can be more challenged. So that's brought up a bit of a not the alarm bells, but it's signaled a bit of caution.
Okay, so I know when you approach the space, you have a method, a philosophy for credit investing. You take both a top-down and bottom-up approach. Let's break those two down. Let's start with the top-down. What are we talking about here?
So, we'll tend to look at different aspects that can affect the economy. It can be something like interest rates that can affect how we're looking to add in terms of the duration of the bonds that we're adding to the portfolio. It could also determine the types of companies. So, there are certain companies that are going to be more interest rate sensitive, and we may adjust that based off what our views on the economy. We can also look at where we are in the credit cycle. We might want to add more credit risk if we think that credit spreads are cheap, whereas we might want to be more conservative if we think that things are more expensive. We may also look at geographies. For example, a few years ago when there was the Chinese property crisis, we looked to reduce that risk across the portfolio. And we can look at all types of things, including even secular trends in industry. So in high yield, for example, there's more exposure to legacy media, so we will want to manage that risk as well. So that's how we'll kind of look at it from a top-down approach. We'll take those factors and try and apply that to our portfolio.
The other part of the process is bottom-up. What are we doing here? What's the discipline here?
So that one is more simple when it comes to, it's similar to value investing, where we're looking for solid businesses that have competitive advantages, have a solid economic moat, and can perform through the cycle. So this is where we'll do in-depth analysis on cash flow, on the balance sheet, on competition, and we'll try to identify winners. And we'll ask ourselves questions like, does this company need to exist? Does it have a sustainable competitive advantage? Does it generate free cash flow? If it doesn't generate free cash flow, maybe there's a path to generate free cash flow. And an example would be Netflix. So Netflix was a high yield issuer. They're not anymore because they were upgraded to investment grade. But there was a period of time for, up until it was a couple of years ago where they were high yield. And when we were doing the analysis on the company, we saw a reasonable, compelling path to investment grade. And that had to do with the fact that even though they were spending a lot on content, there was a clear path to scale based off their content costs and their revenue growth. So even if the company isn't generating free cash flow now, if there's a path, that could also make it a compelling investment. And we'll do relative valuation on various bonds to see, if we believe we're getting compensated for the risk of that individual security.
Interesting stuff. You mentioned media there briefly. It's been a volatile period for media and telecom. So as you take a look at this space and some of the challenges there, how do you approach something like that?
Yeah, so I've been covering media and telecom for over 10 years now. So I'm quite, I guess, accustomed to the space. And for the longest time, especially in telecom, in cable as well, it was considered a very defensive sector. Over the last 3 to 4 years, we've seen a bit of a pivot, both in media and telecom. So we'll start with the media side. On the media side, a lot of the high yield issuers tend to be legacy media companies. So whether it's television or radio, we started to see a lot of turbulence in that space, which affects a large part of the media market in high yield, because it's a large percentage of the issuers. So because of that, those started to experience a lot more volatility, and we had to manage through that. And then on the telecom side, that was dealing with more of the fact that with interest rates increasing, a lot of these telecom companies utilize the capital markets a lot because of the amount of capital investment that's required in their business. They always have to maintain strong networks. So because of that, when rates increased and the time came to refinance their debt, that put them in a bit of difficulties. And for a sector that was previously considered quite defensive, that created a lot of turbulence, and we had to manage through that as well.